So welcome again, once again to the Propfolio Take. My name is Arturo Borges. I'm the VP at Propfolio Management. We pretty much buy, build, and manage $1 billion worth of properties, commercial, residential. And one of the biggest things that we bring to the table is our ability to add massive value to agents, to brokers across the South Florida market. And this is an initiative that we took to bi-monthly webinar series where industry leaders and experts across different fields are pretty much invited to share their success stories, lessons learned along the way, as well as relevant and up-to-date content with the sole purpose of adding value to you guys and so you can become a better equipped real estate professional for yourself and for your clients. Now, in this webinar, as you guys know, we'll go over the fundamentals of pretty much underwriting a commercial real estate investment deals, things you should consider, how to properly break down the numbers, the rule of thumbs, and basically go into the fundamentals that you need to know and to master to properly, again, analyze a commercial real estate investment deal. Now, keep in mind, commercial real estate is comprised of industrial real estate, retail, office, and then commercial multifamily, which is any property that's over 4 units. It's considered a commercial property just because of the way that these properties are valued. Just like any other business, they are valued based on the income they produce. It's not valued on what the market's doing, on what the other guy wants to sell the property for. The emotional component to residential real estate, commercial is solely based on numbers and if it makes sense to buy a property or not, based again on the income it produces. Now, today we have the pleasure to pretty much talk with Julio. Julio is pretty much the asset manager at Propfolio, has a keen ability in analyzing investment opportunities, in managing portfolios, and really driving for that maximum efficiency and performance. He's responsible for overseeing the portfolio of over $1 billion in assets under management across different asset types, commercial and residential. And to me, it's a pleasure to have you here today, Julio. How are you doing?
Hey Arturo, how are you? Good morning, everybody. Well, thanks for the invite. It's a pleasure, being here with you guys and share a little bit of my experience and how we can, a little bit understand the market. We understand that, our time is very precious. So every time that we get a deal, we get a lot of deals. So the idea is to be able to dissect the deal as quickly as possible to understand if it's worth it to invest more time and look into the small details to see if it's a good investment for our investor, for our portfolio, and we can get good return.
Amazing. Yeah, that's a key pointer there. And before we even get started, Julio, I would love for you to tell us a little bit more about you. What is it that you do specifically? Tell us a little bit more about your story, your background, and what you're currently doing with Propfolio.
Okay, of course. So I originally I graduated from finance, bachelor in finance, international business and economics.
Mm-hmm.
I studied in Boston. Then I moved here down to Miami. I think Miami, it's a very, very interesting market. I think there's a lot of opportunity. I started getting involved with a broker in the real estate world. Started doing a little bit of property management that I have the opportunity to come to Propfolio Management 4 years ago. I started from the bottom because my overall goal is to be an asset manager. I completely understand how an asset can perform. In order to do so, I needed to understand the roots of any investment. Because when you see the numbers, they all make sense, but you got to understand the other side. You got to understand with the tenants, they don't pay, when you have to collect money, when you have to do some repairs. So I started from the bottom, starting with calling tenants, looking for quotes, everything to give me the understanding of how a property, can maximize value. Where are the key components that can help us, excel to the next level on the property? Moving on the couple of years, portfolio has expanded and grown drastically, and I started taking over the asset management side, where I evaluate the portfolios of our owners, look at the returns, look for a strategy. How can we maximize some of the revenue and some of the income that this portfolio has? And we have great investments that they are producing. Let's give you an example. this investor invested, $500,000 let's say 5-10 years ago, and they're producing a good cash on cash, let's say 8% cash on cash, but over time that portfolio has increased in value to 1.6, 1.8 million. So the idea is to reallocate those funds into new investments, because it's not the same to have an 8% cash on cash based on $500,000 that have a 5% on 1.6 million. So our goal, and my main goal, is to look for those key elements in the portfolios that we have and try to maximize the return for our investors. Okay, strategize quarterly, trimesterly, the new opportunities that we can come up with in the portfolios and in the investments. That's pretty much what I do. I oversee the property management side. I have good relations. I work on reporting and look for new strategy. And every time that we get a deal, kind of like I do a quick research to see if it makes sense, the numbers, to go into deeper and analyze it and offer it to our investors. So
love it.
That's pretty much.
All right. I love it. I love what you just said, because I typically, when I talk with our clients and investors, I typically say, as a real estate, real estate can get very, very complex, but it's really a simple kind of industry. I mean, if you buy a good property in a good location, you pay the right price for that property. If you're going to leverage, then that you get a conservative leverage. And pretty much, if you have those ingredients you're in front of a potential great investment opportunity. But really, and the more sophisticated, Julio, that you get, and this being an asset manager, your ability to really manage that investment efficiently, so you can, again, drive for efficiency, for maximum performance of that portfolio, is really key. Like exactly what you do. You pretty much look at the long-term value creation strategy. How can you move that money around so it's efficient, and you can not only preserve capital, which is, for me, is the pillar of any investment. I always quote Warren Buffett on this one: is rule number one of investments, don't lose money. Rule number two, don't forget rule number one. So capital preservation, it's huge to me. And then, okay, now that the capital is preserved, is conservatively positioning an investment opportunity, and how can we maximize that value? That's exactly what you do. Now, again, real estate can get very complex, sophisticated, but when it comes to analyzing potential commercial real estate investment opportunity, which is the focus of the Propfolio Take, is investments in commercial real estate. I personally, and we'll get your take on it, try to keep it as simple as possible to better understand, like you said at the beginning, if it even makes sense to put your time and effort into a deal, especially in a market like where we're at today, that's so dry and so tight, and deals just don't really make sense. So my fast kind of rule of thumb, simple approach is I get a qualitative and then a quantitative kind of analysis. The first thing I look at is, does the deal feel good? The location, the property, would I actually want to park my money in that investment? Would I actually want to own the investment? That's the first one. If you do, then I move forward. I get the proposed purchase price, and then I get to my expenses. What's the expense ratio? What are the expenses? Typically, I use a 50% ratio for acquisitions in general. It's a rule of thumb, but of course that's going to depend on the vintage of the asset. And then maybe another 35-40% for very new product, new construction. Now with that, you have your income, you have your expenses, you have your NOI. Then you kind of put your, any current financing that the market's trading for, maybe use like a 65% or 70% LTV, loan to value, at, 4.5% amortized over 30 years typically, and you will get your free cash, your cash flow. And then correct, I divide my free cash by the equity I put in to get my cash on cash return, my cash flow. I believe, and this, Julio, I'm a big advocate of cash flow. To me, cash is trash and cash flow is king. Cash flow is what's going to allow the investor to pretty much ride out any potential storm. That's the only thing that is going to provide an investor the ability to just pretty much hold into that investment, get that healthy, stable cash flow in. And if you're going through a storm period like 08, you have the ability to just not sell, hold the investment, provides cash flow. It covers the operating expenses, covers you can still service the debt, and then continue to move forward until you eventually can sell the property. And then with that information, I ask myself, if this free cash is worth my time and the opportunity cost of the money I'm putting in and investing in these deals, then I go into full underwriting and actually break down the numbers. Underwriting is pretty much just that process of collecting and organizing that, the information and financial information specifically needed to build that projection of income, of expenses, pretty much a pro forma, and investment returns. Now, to talk about you, Julio, and for you to illustrate all of this much better, first of all, I want to know the big picture, pretty much what I just said, my rule of thumb, the big picture when a new deal comes across your desk, a regular day at the office, a Monday, new deal comes in. What do you look for in that deal? What are those 2 or 3 things that you first look at in that deal to see if it's even worth for you to actually go into full underwriting mode?
So Arturo, I think you nailed it. I mean, it seems like you actually know a little bit about real estate, which I'm very, I think you
Right.
nailed it in all of the points. I couldn't agree more with you in pretty much what you said. I mean, for me, cash flow is key, is the key of any real estate investment, and I believe is the key factor of any investment that you could make over time. Very important that will support your analysis on cash flow is when you look into a commercial deal, as we have talked, and this is mainly focused on commercial, cash flow has to be key, because at the end of the day, if you're going to sell the property, because we all have an exit strategy, you're going to have to base it on a pro forma that the asset is trading. Okay. Right. To give you an example, we all know here in Florida, South Florida right now, the single houses are very hot. Okay. Right. So whoever bought a property 5 years ago, they had this strategy of selling it to an end consumer, someone that is in love with the property. They're willing to pay a premium for the property because they're going to live in there. Right. On the commercial side, you don't have that, because you're not going to live in a commercial building. You need to sell it to another investor. So cash flow is extremely key when we talked about commercial real estate.
For sure.
Definitely agree with you. 50% operating expense is a great rule of thumb. The loan to value ratio, I agree with you. It could be between, 80, 60, it depends. Interest rate now, it's very, very low nowadays. I always say try to look for deals that are 20% a discount what the market is trading, to make a little bit of sense. I have the 1% rule that the rent should be 1% of the value of the asset. Some debt to cover ratio has to be at least 1.3, 1.4 to make sense for you. Other key factors, we need to take consideration vacancy. A lot of people, they don't take consideration vacancy. I mean, there are other many rules. I would think about the 30%, 32%, 30% rule, which is your property taxes, your insurance, and your condominium or HOA should be around 30, 32%, no more nor less. If it's less than that, something is not right about the deal. Good returns or good cap rates that you should be looking for should be between 6.5, 9.8.5. I think that's a good range. Below that doesn't really make sense. And if it's much higher, 10, 12, I will definitely advise you to go into detail, because it doesn't really seem right. It doesn't mean that it cannot happen, but it could have something that they're not taking into account. Okay.
Right. Okay. And because I believe that you have a deal for us to actually share your screen and actually see how we can approach an analysis. But before we go into that, you talked about cap rates, and that's a very particular point that I always think about, because typically investors, they look at cap rates, and I myself historically well, my question to you is how important is a cap rate to you? I personally, the way I see it is a cap rate more than a measure of return really is a measure of risk to me. The more compressed a cap rate is, technically what that means is you're investing, you're positioning yourself in a more conservative type of investment. Maybe it's a newer type property, better quality asset. Maybe it's a better location that has more demand, that has more long-term stability. But really, I mean, especially if you're buying, depending on the vintage, a more, an older property, more of a value add. And I always talked about this. We actually talked about that last episode. If you haven't seen it, guys, go to our YouTube channel, check it out. Is what makes real estate a unique and a superior asset class. We talk about the risk return spectrum, the core plus, the core, the value add, the opportunistic kind of strategies. So if you're more of a value add type of investor that wants to buy a piece of property, renovate it to be able to then increase the rents, increase the income, the operating income of the property, which is going to have a direct impact in the value of that property, then whatever cap rate you buy that property for doesn't really have much impact as many people actually put into cap rate. So I wanted to get your take on it before we even deep dive into the deal, and then I'll allow you to share your screen, Julio, so we can actually see the bigger picture of a deal. You got an OM, I imagine, came across your desk. What do you see to see if it's pretty much what you just said, to see if it makes sense for you to actually go into full underwriting, and then we'll go from there.
I agree with you. I mean, cap rates, it's what we call it's basically seen as a rule of thumb. I mean, right. It doesn't really direct you or tell you exactly how the deals can perform, because each deal has so many options that you could do. You could have a building that has three floors, and then you take it down, and then you have a 10 because the zoning has changed. So it's also looking at the possibilities and how you can turn the asset and how can you maximize return, what you could do in the long, medium term to, to get that asset to the next level. So cap rates, it is one of the first things that we do, because remember, everything that you do extra, it will be great for you or for your investment. But you gotta, as you said, if something comes and hits the fan tomorrow, with a recession, you got to be able to keep that property and make sure it holds itself during the storm, so you don't have to put money out of pocket, call some investors to get some cash back into the investment. So that's one of the things that you have to definitely look into it. As you said yesterday, I came across, one of our investors sent me a deal. It's a multifamily trading. Let me see exactly the information I have here. I got a text yesterday.
Got it.
Remember that every time that you get a deal, the deal could be completely different. Could be from very detailed presentation where you can actually dive into the numbers. Could be a simple message. Hey, I have this multifamily for 1.5. What do you think? Are you interested? And the main key of this webinar is to see that whatever you have and try to come up with okay, should we move forward and invest our time on this deal? Or should we just say, no, it's not for us, thank you very much? So that's pretty much the take on this. So let me look for it. So it's in Little Havana. Okay, it's 8 units. It says that the rent is between 950 and 1,200. It says that has some rehab in 2014. That the roof was renovated, and they're asking for $1.25 million for this deal. Okay. So the first thing that caught my attention was Little Havana. I mean, we know this area, it's getting hot. I mean, Miami is expanding outside. So just because the area, it might be a good deal. So I think it's worth it. Look into it. One thing that I wanted to bring to the table is these are all 1-1s. So one bathroom, one room. So historically, and I prefer 2-2s, and I'm going to tell you why.
Please.
When the economy is doing great, okay, everybody wants to live by itself. Me as a single person, I want to live in my apartment. You want to be living in your apartment. and then it's a lot of rotation. Maybe I don't like this, I'm by myself, I can move here, I can move there. So usually when you have ones, you will have a lot of rotation on your property. When you have twos, you get a little bit more stability. Let's say we are roommates and we're living, in this apartment, and then you decided to move, to another state or something, but I like the place. Most likely we'll find someone to replace you, and then we come up together. Okay, that's one thing.
Right.
The other thing is when the economy start hitting like it did with the pandemic, people start moving together. I can't afford to live by myself anymore because it's too expensive. I'd rather move with someone and save some money. So the twos, it's kind of like helps you when the recession comes, and it helps you with the vacancy because people tend to stay longer on two units. It doesn't mean that you have to look for twos. There are great deals that are studios, ones, two, but it's just an overall rule of thumb of, people tend to stay more and vacancy tend to be less when you have two rooms than when you have just one studio. Okay.
So are you a little bit skeptical about the deal just because of the unit mix, or not necessarily? What's your
Not
thought process
necessarily.
behind it?
So not necessarily, because the way that the deals is structured, from what I'm seeing, it's a little bit of on the low income side. Okay.
Yeah.
So most likely we're not gonna see a one person living there. We might see a little family that are gonna stay there. You always want to try keep families, because if for me to move my things tomorrow is I get my luggage, put my things, and I go.
For
If
sure.
I have a family there, one is probably going to be a little bit more stable because there are two incomes in the property. Second, move a family, your wife, your kids, your friends, whoever is living with you, it takes more time. So I don't see that happening here, but we could be wrong. Okay. So these are all the angles that we need to analyze. So I like the location. I think it's in the right mix. Okay. In the kind of like mid-income, low-income side, for the location and for the price of the property. Looking at my 1% rule, here's 1,200. Is $1,200 per month. We have to multiply that by 8. I don't think you'll meet my 1% rule based on the price, which is 1.25. So we'll have to dive in a little bit more deeper into the numbers to see.
So in now for purposes of the webinar, we're gonna go deeper into the deal, but would you actually take a look further into this deal based on the information that you're telling us?
Yes, I will definitely look into it for a couple of reasons. As I said, Little Havana, I think it's a great location. It's expanding. Okay. It's an 8-unit, which means they're all together. It's easier to manage a property when there's one building, 8 units, and you don't have, let's say, 8 and 8, because it's easier just to have one person there. The price a little bit, I think it's a little bit high. We all know what's happening here in Miami with real estate, or Florida with real estate. It's a little bit booming, so people is probably putting a number. Okay. The idea is to come up with that actual number that we believe it will fit this investment opportunity and back our facts. Okay, I'm willing to offer you this based on this analysis that we did.
For sure. Okay, amazing. Now, what would be the pieces of information, Julio, that you would need to actually go full blown into underwriting? Maybe it's the T12 and rent roll. What are those pieces of information you would need to further look into the deal?
The more you can get from whoever is sending, the better. I mean, there are little things like this might be electrician, it might have gas, maybe the water may hit parking. There are a lot of things that I'm not seeing here. It has common areas. It has a beautiful garden that it could be appealing and could be looked because the building looks good. But if you have a big garden, you have to spend on landscaping. What are the surroundings about this area? Do we have, some commercial like laundry, supermarkets? What is so hot about this deal? Those are the things that I need to understand a little bit of the demographics of the surrounding of the property. Okay.
Let's dig a little deeper into the actual location, because I think that that's very, I mean, we know the 3 rules of real estate: location, location, location. But I would love to learn a little bit more, because through the different commercial asset types, there's, fundamentally it's the same things that we look at. But for example, a location for retail kind of property versus a multifamily is going to vary a little bit, meaning maybe for a retail property, and correct me if I'm wrong, Julio, in your opinion on this, for a retail property, you want to look at more of a like the actual location of that property is going to be even more important than a multifamily. Maybe a multifamily, you want it to be close to a main road, close to the highway, but in a place that's quiet, that's actually neighborhood kind of setting, that's near to necessity based, retailers, near schools, near hospitals. Maybe for a retail property, you want it to be actually main road, as crowded as possible. The visibility is very, very important for retail. Like, it's got to be pristine. So in terms of location for this specific property, what would be those things? Like, maybe it's a Walmart, maybe it's a McDonald's, maybe no, it's at Starbucks, or it's a Whole Foods. I mean, what do you like to see near a multifamily property like this?
Well, usually you want to look at the first necessities that everyone could have.
Right.
I mean, maybe a pharmacy, supermarket, easy access to the highway,
Right.
good location, not too crowded. I mean, you don't want to be, you want to be on a residential zone. You don't want to be on a street that is very, with a lot of, clubs, restaurants, because, it might, people don't tend to like that. There's a lot of people going around. Then the higher, the traffic gets very stuck. People get frustrated. So it generates you a lot of turnover and vacancy. I agree with you. I believe every commercial deal, as you dissected, you have the residential side, the retail, the office, the industrial. They all have different caveats that we can look into it. And definitely, locations might vary on depending on the type of asset that you're looking. If you're looking at retail, you want to have completely the opposite. You want a place where everyone goes and everyone can see and walk around. It has very, flow of cars and people around. If you want an industrial, you want to put on a part where you can get the highway right away. You want to have, your space, very wide streets, because you have the trucks loading and those kind of things. So all that will take place for every different asset type. It will depend. In this case, that is a residential, I will look for those kind of things.
Amazing. Awesome. Julio, can you share your screen, or do you need me to I think I gave you access already, right?
Let me see. Yes, you gave me access.
Amazing.
Okay, let me share my screen here real quick.
Okay. Guys, what Julio's gonna do right now, which is the main goal of this webinar, is give you guys these upper level vision fundamentals of how to actually open up the spreadsheet and actually start plugging in the numbers to break down this deal, see if it makes sense.
Can you see my screen?
Yes, we can. Amazing.
Let me look for, I'm gonna open here. Okay, I have a Google Sheet, blank Google Sheet that I just opened. Something that I have to tell everybody or the audience is it's very hard to work in somebody else's Excel. They usually send you, here's the Excel, and you try to work on somebody's Excel saying, and it's complicated. You could have very, very detail oriented Excels that you don't really understand. I will strongly recommend all the audience to create their own. You could have like a small cheat sheet, and then you just plug some numbers as a rule of thumb. And then if you're gonna go detail more, you could use great tools that they are out there to do that. Okay.
Amazing.
So according to the deal, we have 8 units. Okay. They're asking price. So let's start with units. So that we have 8 units. Okay, price per unit. They're telling me that the price is between 950 and 1,200. So let's do an average of that.
You're talking about rent per unit?
Correct, rent per unit.
Right.
Okay. So that's the average that we get. Obviously, if this is gonna be a quick snapshot of the property, technically I will have to go into detail and then go into the market to see what the actual rent it is. But based on the information that he's telling me that he has, this should be the actual, okay? He's telling me that the sale price is 1.25, okay? $1 million, okay? And then he said that it's located into Little Havana, which is a little bit, you know, we already talked about the location, okay? So the first thing that we need to do is the monthly income that this property is gonna have, okay? So we're gonna go this number, which is the number of unit times this, okay? This is, and then according to my 1% rule, okay? This number, okay, divided by this should be around 1%. So we have 69%, less than 1%. So by this, I could tell you that the numbers won't make sense just because of this. I could be wrong, but it's a hinge that I have, okay?
All right.
Then the other rule that we talked about was, okay, so this is the monthly income. Okay, so let's do a yearly. So we're gonna multiply this times 12. Okay, that should be the yearly income for the property. According to our 50% rule, you have a 50% expense. Okay. So we're gonna go here, which is pretty much half of that. And then we're gonna look for the cap based on this. So this one divided by the price. So technically, based on our rule, this is a 4.13 cap.
What do you think of that, Julio?
I think it's a little bit low, okay, for what I'm seeing, because first, I'm not taking consideration vacancy and other aspects that we're gonna dive in detail.
Right.
As I mentioned before, I believe the market is pretty hot and they might be, you know, jacking the price a little bit. At this point, I will definitely look deeper into the numbers to come up with the actual numbers that I believe could be, and to make sure that I'm looking for the right number. Oh, if I'm gonna counter offer this proposal, I have a solid answer on why. So something that I like to do is the ideal cap. Okay, so the ideal cap will be, what do you think is a good ideal cap for you? What were you looking for?
Meaning your return expectations. What would you expect for that cap to be that makes sense for you?
Actually, well, I did a small mistake here, but because it was 50%, but because it's in the NOI, so you have to retract the income, which is the same number technically. But okay, it's gonna get the same number. Yes. What cap are you looking for? Like, what do you think is a good cap?
Sure. I mean, let's say, you know, that's something that it goes, I'll make a parenthesis here, which is very, very important, especially many of you guys that deal with, many of you that are hearing this webinar are real estate agents, brokers, and some of you that are investors as well. But the return expectations and how you have to educate your investors and clients on where the market is at and the expectations of returns, meaning you can't expect the same returns you were getting 10 years ago here in Miami, in South Florida, to be the same ones as today. So even though, of course, I want to buy a 7 cap, I got to adjust those returns expectations. Typically, cap rates right now for multifamilies in South Florida, properties are trading between 3.75 and 4.7, the cap. So ideally for me, it would make sense, to your question, Julio, 5%, but I just know that's a little bit unrealistic.
Okay, 5%. So what I call about the ideal cap is, let's say this number it was less, so you want to know how much, based on this quick analysis, how much should he sell me the property so I can obtain my 5% cap. So I divide my NOI by this, And technically, this property, to get 5% cap, the one that you're looking for, the ideal price should be 1.32 thousand. That
Right.
should be the price. And how can we make sure this is correct? If we put here 1.32, the original price,
Mhm.
you see, we get 5%.
Right.
So
Amazing.
this is strategy here, real quick. It will tell you right now that, you know, he might be offered $250,000.
Mhm.
Okay. So based on this quick analysis, I think we can definitely dive a little bit more into the numbers to see what we can come up with. Okay.
Mhm. Mhm.
So let's look into this. So basically, I'm gonna go and it says here's the yearly, okay, and this is the monthly income of the property, okay. We're gonna include some vacancy, okay. Let's say it's 5% vacancy.
Typically, Julio, and I'll stop you here. How do you run vacancy rates? I mean, in your head, typically, we tend to use about 5% vacancy because, you can always, I mean, as you can put, you can always make a performer look amazing. You can always also break down a deal by stressing it too much. But what's your thought process behind running vacancies?
So I believe when I get a deal and they say it's fully rented and you should not consider vacancy, and a lot of people don't take into consideration vacancy.
Right.
It's one of the silliest mistake that we might all make, that we don't even take in consideration. We all know the property won't be rented forever. We'll have, we have turnover on the property. I think 5% is a good number. We have properties that have 7%, have 3%, but I like to have a 5% kind of in the middle. And it will affect the numbers. Believe it or not, it will really affect the numbers, the vacancy.
Okay, great.
So something that I would like to tell the audience to do is we're doing some formulas here. You could see which ones has formulas and which are not. So what I like to do is I like to put in color the numbers that I might have be using to change. Okay, so I know if I want to make a change on any number, it will automatically. So this will be the numbers that I'll have to change for my quick analysis to change. Okay. So we're gonna take this vacancy, 5%, okay, for the yearly income. And this is how much, let's put this in a negative sign because it's a negative number, okay? And then technically your new income will be, your yearly income plus or minus your vacancy. So this will be your new number, okay? So this will be, let's put another column here. Oh, let's insert one here. Above. Let's go above here. And let's put this as the income side, okay? And then we're gonna go to the expenses. So technically we said that was 50%. In order to better understand the expenses of this property, I will have to understand if it's electricity, if it's gas, if it has a landscaping, if it has, trash collection, pest control, internet, all these things that we don't really know. But since I have a little bit of experience, I know what we should look into. So the first thing is the property taxes.
Right.
Okay. Then we can look into the insurance of the property. And let's call it utilities, which will include water, sewer, trash, anything with that relation. Something that a lot of people leave out is leasing. You have to pay a realtor to rent the properties, and that's an expense that most likely people won't take into account. Management, it's very important. You will see a lot of investors that will say, I'll take care of the building myself, and that it's completely okay. But you gotta, as you mentioned before, your time has value. and that you have to put that into the equation. And if tomorrow you won't be able to manage, you have to be able to account for that expense, because remember, not all investors think the same way, and technically management is a key piece of any investment. Okay. Then you have accounting. We always have to do some accounting, you renew your corporations, you do your taxes. And let's include some repairs, some general repairs here.
What about, Julio, concessions? Typically, I mean, that's going to depend on the type of property. Maybe a newer property is going to need more of a concession, bigger expense than an older property, depending on the location and many other factors. But what about concessions? What about bad debt as well?
So technically, when I look into the deal, I want to understand the deal on a cash perspective.
Okay.
Debt is very important to maximize return, to move the money around, and to diversify. I don't take into account, another thing that I don't take into account is taxes, income taxes, because every investor is different. Every investor have their own structure on, and so I don't know how much taxes each one will be. Each investor could have, a large, portfolio, and then they'll give him a really good interest rate, or they have, they don't have a great credit score, and they'll give them a very high interest rate. Interest rates are a little bit increasing as of today. So that's some things that I will put some kind of numbers there, but it will change depending on the investor.
For sure.
Definitely you need to have some reserve, because you don't know what things are going to happen
as well.
And you will come up to that number later on when you actually are very interested in the deal, and then you do an inspection and new things will come up, like you need to do the new roof, you need to change the pipes, you need to change this, it has termites, a lot of things that will come onto the inspection that will help you to account for that. Either you put it as a side, as a reserve, or you could ask a discount when you close the deal. Let's say you have to do a new roof, it's going to cost you $100,000. Okay, give me a discount, $100,000. I'm not going to pay for it, but I'm going to do it, 1 year, 2 years ahead. Okay.
Got it. Julio, maybe to just put that out there, I wasn't talking about debt, because when you're underwriting the deal, that's an assumption, what kind of financing, or if the investor is going to buy cash. I was talking more about the bad debt, delinquency, people just not paying their rent.
I'm sorry, I
No
didn't
worries.
get that. So definitely that's something that you need to take into account. That will definitely depend on, the management of the building. If something that has come to my attention before is, when you have this owner tenant relation very close, the tenant believe that you are his friend, and the other way around, and you start forgetting things like, okay, don't pay me on the 1st, pay me on the 5th, pay me on the 10th, pay me on the 15th. And then the tenant say he's not gonna care, and then you start losing possible income, such as late fees that you might charge. Remember that you have to pay your debts and everything, your dues, on the first week of the month. So it's very important you to collect the money. Okay, so that's why management is very key there. Sometimes when you have a tenant that is not paying you, going through the eviction process, it might take a lot of time, a lot of effort, a lot of money. So you have to negotiate with them. Just give me the keys, let you go. With COVID that just hit us, we were a lot concerned with the delinquency on that side. Surprisingly for us, we did an amazing job. The team was able to help them take payments with credit cards, propose payment plans, payment agreements. So our delinquency was very low during the pandemic, believe it or not. So that's something that you need to take into account when you manage the property. But when you analyze the deal, you can't really put it there, because that will depend on the people that you put into your building and who manages the building. Okay.
Amazing. And that's a great point, Julio, that you made there, because the management the management efficiency, meaning whenever I get a deal and I know that in the OM or just the broker tells me, or whoever is selling the deal tells me that has been self-managed or it's been, mom and pop managed, I already know for a fact that there's management inefficiencies. And again, the great thing about commercial real estate is that the properties are valued based on the income they produce, and you can directly impact the value of the property by either increasing income or decreasing expenses. And so while it's not really a conservative approach to investments, to assume that you're going to be a better manager than the previous owner, I mean, if you're, for example, if you're like a management company like us, we manage $1 billion worth of properties. We have a full-blown team, full departments, technology, proven track record of success. If we're gonna take over a property from a past owner that was just this lady or this gentleman that used to manage a property for himself or for the client, we almost know as a fact that we're gonna be able to better and more efficiently manage that property, to drive for efficiency, to things like that, pricing our rental rates accordingly to make the rent increases, to work with the tenants in a way that we're able to provide them this world-class service, that they're happy, that they're well maintaining the units, they're making the rent payments, but that we're doing what needs to be done. So that's a great point that you brought there. So keep on going.
Awesome. So I'm gonna add two more things here. I'm gonna add some pest control into the building, because usually these multifamilies, they require a lot of pest control, just because it's very, a lot of tenants coming back and forth. And let's assume that it has some landscaping,
right?
Just for the exercise.
Mm-hmm. Guys, by the way, we're going to answer all of your questions. You can put them in the chat. We'll answer them at the end. We'll do a small Q&A session and we'll get it answered. Okay. So go ahead, Julio.
So technically, when you dive a little deeper, like we're doing now, you can make some assumptions, but you can always look the property taxes. You can look at it in public record. Insurance, you might have to quote one of your, any ally that you have on the insurance. Well, I have this property. What do you think? How much, so you get a real insight. Utilities, you will have to put a number there based on your experience, because you don't really know if they don't provide you. They might provide you with that. So all these assumptions that are gonna be making, they're purely based on some rule of thumbs that I have, I'm advising you guys to use. Another, if you want to have a more precise number, you could look into it with, as I say, public record, some allies. We know how much leasing could be, management, and those kind of things. Maybe you have an accounting, etc. So usually for property taxes, I put 1.2, 1.4% of the value of the property. So we're gonna put this one, the number that they gave us, times this. And then what I'm doing here is I'm putting, okay, here a percentage of how much this expense is from my income. Okay, remember that I have mentioned that this number here should be around 50% when we add them all together. Okay, and we talked about property taxes, insurance, and HOA, which I'm not including here because we're assuming that there is not HOA here. Should not be more than 10%, 30%. So usually insurance could be something between 5%, 0.5%, 0.4%. Let's put this for the value of the exercise. Okay, this one times. Okay, I have to log that cell. It's very important to log the cells. Okay. So utilities, okay, let's put the ones that we know. Leasing, let's put 8.3, okay, percent.
Where does that 8.3, Julio, comes in?
So 8.3 comes to you're giving up a month of renewal. If you divide 1 divided by 12, that's exactly what you get, that you're paying out a month of commission. And that's a rule of thumb. Every time that you have a vacancy on any unit, you have to rent it back, and 8.33%, it makes sense. This will
Right.
be this number, okay, times the actual, okay, yearly income. Okay, so these numbers, as I mentioned before, we're gonna put it on blue, okay? Management for a multifamily, could be between 5 and 7%. Let's put 6% of this. So we're gonna put here, and this is the yearly income, okay? Then you have, some accounting expenses. And remember, I'm putting these numbers in blue so we can manipulate them. Let's say, okay, well, I believe 1.2 is too low. We can change it 1.4 and my Excel will do the rest, okay? Accounting, let's say that you have to renew your corporation and then you will have to, pay accountant at the end of the year to pay for this. So let's put, I believe $800. It's a number that could make sense there. Then you have some repairs. Let's put, as of now, $1,500 as of repairs. We have to take into account some repairs. Less pest control. Let's say it's, let's say $65 a month for a pest control, basic pest control. Maybe they don't have pest control, but you should do. So we're gonna multiply this by 12. Let's say it has a landscaping of $100. So this one times 12. Utilities, it will vary or will depend on what you are entitled to and what you are not. Let's say that the tenant is responsible for paying their utilities, which mean water and electricity. Most likely the owner will be responsible for paying what we call the trash collection and maybe some common areas. So let's say that the utilities could be around $5,000 a year. Okay. So look at this. It came down to 60% on expenses. It's more than what we actually thought.
And how many times, Julio, would you say, whenever you get a deal across your desk in an OM that says, it has an expense ratio, for example, in this case, 50%, how many times is that really accurate?
So it's the people usually, if you will receive a pro forma from someone that is trying to sell, they will tell you, okay, you got to do your numbers. So
Right.
I guarantee you they will take out this. They will take out this. And they will take out, maybe, I'll put 50,000 here. That's a lot. That's why again. And they will take out, they'll tell you, no, just $2,000 here. So look, it's a 39% expense and the numbers makes more sense. So that's when you need to come up to do your numbers.
Sure. Okay. Now you have your income. I just love it how everything is well put together. Again, the simplistic, the simplistic nature of real estate. I mean, you have your income.
The total expense changed because I have $15,000 in repair. I add another 0, 5 fingers.
Right.
So I put 2,000 and it came out to 46%.
Got it.
Okay.
So you have your income now. You have your expenses.
Let's do this real quick. So technically what I'm doing here is I put $5,000 here. That's a $400 utility. I believe that's a little bit low. Trash collection could be between $400 a month, $600 a month, just for the company to go collect the trash of the property. And if we include some common area maintenance, electricity, and if we want to include any, let's say, vacancy that we have to pay for while it's not there. So let's put that we spend $800 a month on extra utilities, which is not really crazy if you think about it, times 12. So look, it come up close to the number that we mentioned, the 50% rule. It's a little bit higher. If I'm the person that like to penalize the numbers when I'm trying to understand the deal, okay, I want to be conservative to make sure, the deal will hold through. Okay. Other things that you might have here is, let's put some reserve here for, let's say that you want to have a $1,000 reserve. Okay, so that's pretty much your numbers. Accounting 800, 1,000, it could be. So looking at this, taking into account every single aspect that we look into it, look, we come up pretty much to our rule of thumb. Okay,
Amazing.
so we add them all together, $51,000 expense, and we come up with our rule of thumb. Very close, as you can see. So we're gonna do the final number. So we're gonna have the revenue.
So you have your
or what we
income.
call the now operating income, which will be your new income divided by minus the total expenses. This is your new NOI. Okay. So basically the cap rate of this building, okay, so this one divided by the actual number that we get here. Look at the numbers. It came down. So 3.73, 4.13. We're not that off, but when we look deeper into the numbers, taking into account vacancy, taking into account all these small details, this deal is at 3.73. Okay.
Right.
So you talked to me that you think 5% is an ideal cap. Remember? So the price, the ideal price, according to what we discussed, is this one divided by this one. So this should be the price that would make sense for me to pay at a 5% cap. Okay.
What percentage, Julio, of a discount would that be from the original asking price?
Let's look into that. So this divided by this. So that's 74 is 25%. So this one minus one. So 25% discount. It's pretty much what we talked at the beginning. 20%, 25% discount on what they're trading. It should be what you're asking for. So if you look into it, the rule of thumb, they're very accurate. So, I mean, you could break it down like we did. And it came up to the numbers that we talked: 52% expenses, 25% at discount. And let's say that he said, no, but if you leverage this deal, it will make more sense for you. So let's do some leverage here. So let's say, okay, so the purchase price is, purchase price. We said it was this number right here. Okay. We talked about the loan to value ratio to be between 20 and 30%. So let's say that you put a down payment of 30%. 30%. This one times this one. Okay. And then your loan will be this one minus this one. And then let's just, for the purpose of this exercise, let's say that you're going to do only interest, because we can get an amortization table and interest. Okay. And let's say it's a 4% interest. So you're going to have to pay 4% of this. So that's $35,000 that you have to pay. Okay. So your new cash on cash will be, so you have to take into account your income, okay, which is here, sorry, minus this expense divided by your down payment. So that's your cash on cash on a leveraged deal. Let's say if this makes sense, we talked about the DCR rule of sum, debt to cover ratio, which will be the revenue, the NOI income divided by this is 1.3. So it holds a financing. You see, if you have a DCR between 1.2, 1.4, the bank, that's what is looking, that you have at least 30, 20% more to
Right.
pay, you know, as a collateral and something happen. If this number will be lower, you know, doesn't really makes more sense. So you're taking a 3%, at 3% of your $375,000 that you're making. Okay.
So the DCR, the debt service coverage ratio, guys, is very key, very important in commercial real estate. That's pretty much one of the main things that banks, that these senior financing lenders are going to look at, which is, like Julio just said, it's pretty much the income the property is producing and how you can service that debt with that income that is producing. So it has room for you to be able to actually pay the debt. So not only is it something you want to look at a strong, a healthy debt service coverage ratio for yourself and for your investors to be conservative, but it's something that the bank actually asks for. So depending on the market, you're in a primary market, a secondary market, that's going to vary a little bit, but it has to be at least 1.25%. That's what the banks look for. And depending on the market, it can be, you know, as high as 1.3, 1.35%. So they wouldn't even lend you the money if it just does not meet that DCR requirement.
Ideal price at cap. So remember that to me, this is the one of the most important formulas that you will guys have, is the ideal price at the cap that you're looking for. So my comeback to this deal will be, hey, for me to make sense, I will have to pay $932,000 or $950 to make sense to me. Would you be willing to go down on that? And then you test. So we know it's a 20% discount on the deal. If they say no, I'm very firm on the price, I will pass. I would not go any deeper into that. I wouldn't ask for rent roll. I would not ask for, you know, I would not go for property taxes. I would not go for getting these numbers more into detail, because once you get into detail, I guarantee you this number might increase and the deal is gonna look worse. So in order for me to make sense, this number right here should be a little bit higher of my ideal. So I should get a, let's say a 5.5 here, because I have a 5%, 0.5%, you know, rule of thumb of error if something happened. So I would not go for this deal. I think it's too expensive. If they will sell it to me for 950,000, the numbers change. You guys see?
Right.
Now I have a 50% cap and I have a cash on cash with a DCR 9% cover ratio.
That's amazing. And that's pretty much, and Julio, this is something, guys, we're going to actually share with you. So you have that basic, okay, Julio said, you know, typically you want to build your own kind of simple model that you actually understand. But I think that this is pretty straightforward. It's going to allow you guys to, you know, to have that, you know, basic Excel spreadsheet to start putting together your own deals. But that's, I love it how the cash on cash talk a little bit about the power of debt within real estate. I think it's very, very valuable, because it's one of the asset classes we talked about, again, that in the previous webinar, one of the asset classes that pretty much one of the only asset classes that have that power of leveraging yourself. If you have $1 million in cash to invest instead of actually managing $1 million in assets, you're able to leverage yourself to maximize cash flow and to maximize that investment, instead of controlling $1 million where the assets, where the money, you're controlling $3 million worth of assets by leveraging yourself conservatively. And that's how the power that it has to build wealth. So that's that. Now, guys, you can ask some questions. Let's start to wrap this up. I think it gave us a very big picture. Julio, it was amazing. I'm going to ask you one last question, but before we do that, guys, any questions you have, put it in the chat before we leave. Let me take a look here. Any other questions that you guys put? Julio, Maria asks, can you please explain a little bit more in detail the 1% rule from the income and the value of the property? Can you go a little bit deeper into that?
Yes. So technically, when you look into the 1% rule is to make sure that the revenue makes sense. And I was looking into it here right now. So remember the original number that we have here, okay, was an average of what they told me the rents were, okay? So if we go with our 1% rule, okay, which will be 1% of this amount, put that here. Okay, so this is the number that I get. So if I put here 250,000, 1,000, sorry, which is almost 1%. Remember, this is time 8. Look at the numbers. The numbers change. You get a 4.5, 5.68. So technically, you should get 1% of the rent. Let's say that one unit is selling for $180,000. The rent should be around $1,800. That's pretty much what the 1% rule is. In good, if you want to find a good deal, I mean, it's very hard to find the 1% rule, but if you are 30% of the value of the property, it's a no right away. When we did it, it was 70%. So it's okay.
Right. That's typically what happens, guys. Again, last chance to ask any questions you may have, but yeah, I mean, it's funny that you say that because the market in Miami, South Florida continues to get more and more expensive. And typically what that means is smaller private investors get priced out of the market and they start to go to these growth markets, like for example, Tampa, like Orlando, where they can actually buy property that still makes sense. Based on those return expectations and in a market like Miami, as it continues to grow, to mature and to develop, is going to get more and more institutional. Is going to eventually get to a primary market like New York, like Chicago, like San Francisco, LA, where small investors just cannot compete anymore in that market. So guys, I think no other questions. Julio, last question to kind of wrap this up. Well, I think that the thesis, the upper level vision again of everything that we talked about is being conservative in your underwriting, breaking down the numbers, having a qualitative and a quantitative kind of approach to your deals, and then everything you do, it's in light of possible upside and downside scenarios, always being conservative. Again, cash flow is king. You want to have a stable property, quality asset, good location in the path of progress, very well located, and just a cash flow that allows you guys to hold that property for as long as you possibly can. And then a plus, depending on what your return expectations and your risk appetite is, having the ability to come in with a business plan. Maybe is you having this gap where you're coming into this investment, but then you have the ability to come in with a CapEx budget and put in $500,000, $100,000, whatever the case is, to renovate the property, renovate the units, the interiors, renovate the exteriors, the common areas, to then be able to justify a rent premium of $25 a door or $55 or $100 a door, which again, based the holy grail of commercial real estate is that forced appreciation. Again, you have your income, your expenses, your net operating income. The value of that investment across all commercial asset types is going to be based on the income it produces, and you have the ability to manipulate that income by increasing that or decreasing the expenses. So Julio, based on everything you said, what would be your last piece of advice to everyone watching on your approach to analyzing a commercial real estate investment deal?
I would say stick with the rules that we mentioned here, the 1%, the 50%, the ideal cap. We all know how value time is. So you don't want to get yourself into a deal too much if it's not gonna be worth it. That's on the analyzing deal side. But I think one of the most important part about real estate and building wealth and building relationship is something that we have in our company that has, take us to where we are is, creating relationship and transparency with the investor is extremely key.
Right.
If you are very transparent with your investor, they will appreciate everything that you do for them and they will trust you blindly. At the beginning, all investors are a little bit hesitant about putting money here, putting money there. It makes sense. But once you exceed that level of transparency to them, they will give you anything, they will go against, go with you 100%, they will trust you. If you get that trust for them, the rest will come on very easily. Sometimes we want to make a deal because there are some incentives on the deal, but reality is if we get a good relationship and we build this community around us, more deals are gonna come. So it's okay to say no to deals that don't make sense. Okay, guys, I think that's one of the most important parts that I want you guys to take from this webinar.
For sure, Julio. I think that, and I love that point. If you don't have transparency, I think you don't have trust. And if you don't have trust, you don't have anything. Your ability to really, do what's right for your investors is the number one, the most important, the genesis of within the industry and the relationships you're going to be able to nurture down the road, long term. Now, guys, thank you very much for coming on board. Again, this is a bi-monthly webinar series, industry leaders, experts like Julio across different fields within the industry, sharing their lessons along the way, everything they've experienced, and actually equipping you guys to become better, more prepared real estate professionals and be able to add more and more value within the industry. See you guys in the next one. It's going to be a couple of weeks down the road. You can text me directly. You can call me 305-785-5594 if you have any questions about the webinar, anything that we talked about, or just to learn more about what we're doing and how you can, be a part of that as well. Again, we're going to be sharing this little model that Julio made. I know for a fact that it's going to be very valuable for many of you guys. So again, thank you very much for coming on board, Julio. Thank you very much for coming in and sharing with us.
Any questions, let us know. Thank you, guys.
Take care. Bye.